Alrighty, guys, welcome and let's get started. As I said, great to see so many of you here and here nice and early. We've got a great session today. We're going to cover lots of stuff that's going to help you guys make some money over the next couple of weeks. So let's get stuck into it. Just a quick reminder before we get started that anything discussed today is for educational purposes only and should not be considered investment advice, financial advice, or a trade recommendation. And no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Make sure you check out the disclosure documents available from optionstradingiq.com/risks. All right, so quick plan for today. We're going to do a little market analysis. I'm going to give you my thoughts on what's happening, a couple of key things that I'm watching. Going to look at some of the tools that I use in my trading that you guys can start using as well. We'll talk about how to deal with earnings reports using implied volatility and a little bit on hedging and protection. And then we'll have a couple of trade ideas at the end there. We'll look at some charts and go from there. All right, so that's the plan. If you've got any questions, shoot them through in the chat. I'll try to answer them as they come through, but if I don't get to them, I'll answer them at the end of the session. Otherwise, I'll email you guys afterwards, all right? If there's lots of questions, may not get to them all. But first things first, one thing I always do with my trading is look at the futures term structure. So I don't know if you guys saw the article that I wrote a few weeks ago about VIX futures term structure and how that can, how we can use that in our trading. At the moment, we're in what's called contango, which is a pretty normal market scenario where the backdated months have higher volatility than the front-dated months, just because there's increased uncertainty the further out you go in time. So that's a typical normal market. That's what you kind of want to see in a bull market. It is fairly flat because the front month's only at 1655 and the back month's at 1780. So that is fairly flat. So we want to just keep an eye on that. When this switches to what's called backwardation, where these front months are higher than the back months, that can be a little bit of a sign that there's some market panic going on, and that can be a good time to just be a little bit cautious. So always keep an eye on that. Another thing I look at is the percentage of stocks above their 200-day moving average, and this is sitting at around 70% right now. So that's a good sign. That's pretty healthy for a bull market. Some of the major declines that we've seen, we had a big decline around Christmas last year. They tend to come when the market drops below about 50 to 55% of stocks below their 200-day moving average. So you see we almost got there in May. We got down to about 50%. So half the stocks in the S&P 500 were below that key 200-day moving average. But we didn't break below it, and that's what's led to the rally here. So the market sort of held on. So that was really good. The only little bit of a concern for me with this one is that, we're getting back up to all-time highs on the S&P 500, but the number of stocks above their 200-day moving average isn't quite as high as what we saw back in April. So, you could say that there's a little bit of negative divergence. Maybe the strength in this latest rally attempt isn't quite as strong as it was in April. So that's something that we definitely want to be aware of and keep an eye on for the time being. Now, you can also look at the same chart, the number of stocks above their 50-day moving average. And again, you can see we're nicely positive. We're sitting at 70%, but it has been trending lower over these successive rally attempts. So the strength of this latest rally maybe isn't quite as strong as what we would want to see when we're pushing out to all-time highs. But, you could also look at it the other way and say, well, there's plenty more room for the upside potentially. If there's a few stocks that still aren't participating in this rally, maybe they're going to take over and start to drive the market forward. So you could look at it both ways. But certainly having 70% of stocks above their 50-day moving average and above their 200-day moving average, that's generally considered a pretty positive sign. Yield curve, obviously, been a lot of talk about that recently. So that's something that we also want to be aware of. This has been a pretty reliable predictor of recessions in the past, over the past sort of 40 years. So we do want to be aware of that, but we also want to be aware of the fact that, a lot of the times the yield curve can invert, but markets actually keep going up for 6 to 12 months after that initially happens before we then get into a bear market. So, just because we've got an inverted yield curve, or we've been in an inverted yield curve, it doesn't necessarily mean the market's going to tank over the next few months. Okay, it's just something that we need to be a little bit aware of, and potentially a good time to short the market might be, in 6 months' time, if the market's pushing up. The S&P 500's around 3,000, maybe it gets up to 3,300 or something like that, and then the economy's really starting to drop off. Then maybe that's a good time to start to look to short. Keep an eye on those moving averages, which we'll talk about. And once we start to break down below those key moving averages, that's when things can accelerate really quickly. So, but for now, everything's okay. So I'd describe my stance as kind of cautiously bullish. So there's not a lot technically to be concerned about with the market, but what I am doing, and we'll look at this, is keeping an eye on those key moving averages, particularly the 20-day moving average on the main indexes. And if that moving average breaks, I'll be willing to kind of flip short pretty quickly. So you can see here, a lot of green on my little trend analysis that I look at here. Not a huge amount to worry about. The Russell has obviously been a little bit weak, so it's the only other area of the market that's maybe a little bit of a concern. The Russell 2000 small caps, a lot of those are, purely American-based companies, so they don't derive much of their income from overseas. So the fact that those small caps are weak, is potentially telling us that, maybe the US economy isn't doing quite as well compared to these other big multinational companies, your Apples, your Microsofts, things like that are deriving a lot of their income from overseas. But generally, you can see here, as I said, a lot of green. So again, we can be fairly cautiously bullish here, but maybe just keep those tight stops in place. So you can see the relationship to the the moving averages. You can see all of the indexes are above all of the key moving averages. So that's quite bullish. So again, we'll keep an eye on those. If anything changes there, if we start to get a bit more red on this graphic, we start to maybe switch a little bit more bearish, reduce that any positive delta that we might have in our portfolios. All right, so let's get to that after, but a couple of tools that I want to share with you guys. So let's take a look at that. First one, as I said, using implied volatility is really key. So let me just get organized here. All right, so implied volatility, this is a really good tool. It's a free tool that you can use, ivolatility.com. I don't even think you need to provide your email to get this information. If you do, you can get it with just your email. You don't have to pay or anything like that. But you can basically go here under tools, analysis, basic options. This will give you your implied volatility chart for the last 12 months, which can be really handy. So you can see here we've got Walgreens. The blue line is historical volatility, what the stock's done in the past. The yellow or gold line there is the current or the implied volatility. So you can see here it's sitting at around 32%. And that's one of the highest levels we've seen in the last 12 months. Now, part of that is because they've probably got earnings coming up shortly, I think on the 27th. So you have to be aware of that as well. I tend to not trade positions over earnings, or if I do, they're more longer term positions. So they're not those short-term options that are going to really fluctuate a lot if there's a big move in the underlying. So they move a little bit slower, those long-term options. We can talk a little bit about that later. But this is a tool that I really use anytime I'm looking at trading a particular stock. You can give me some stock names, but any really, Apple, sort of come in here, and then you can just click on this volatility chart down here on the right, and it'll show you where we're at. So you can see here, back in October, November, December, that was a really good time to be short volatility in Apple because it had a really high IV rank. You might have heard that term before. And then on the flip side, February, March, really, really low IV. That's a time to start looking at long volatility trades in Apple. So that's a really good tool that I use every day, basically, in my trading. All right. Where are we? Next one is, Market Chameleon is another one that's really good for both volatility. This is another one you can just get pretty much everything you need from here for free. They do have premium stuff, but I'm just on the free plan. But this is the one that I use pretty regularly as well. Another one for implied volatility. So as I said, IV rank. You can come in here and have a little scan and see if there's anything that jumps out with really high implied volatility. So that can, might give you some trade ideas in terms of what stocks to go short. As you can see, Walgreens is on there. It also gives you the earnings date over here. So you can potentially avoid some of those stocks if they have earnings coming up. So this is a good one. You can see here Chesapeake Energy, maybe that's a potential really high IV rank, and they've had their earnings already. So probably another month or two before they have another earnings announcement. So that's always a good one. I like to look for ETFs as well. So if you're trading and you don't want that stock specific risk with things like earnings, you could look at maybe this Junior Gold Miners. I know that's a pretty volatile one, but you could potentially look at something there, and then you can just sort of scroll down and see if anything else jumps out at you. Nothing too much there. One thing that would be nice if they had is if you could filter out the ones that have earnings, but I guess you could sort by earnings date and do it that way. Regional banking shares is another one that's an ETF that's not going to have too much stock specific risk. And then you can also do the same for stocks with low volatility and see if there's any options there or any companies there that jump out at you that you might be able to get long volatility on, right? Okay, no major names jumping out at me. I don't know if you guys see anything on the low vol side. And BHP, that's a good one with pretty liquid options. Probably just need to check that earnings date. Momo is another one. Country ETF Mexico. So little things like that. That's something that I'll do pretty regularly in my trading. And the other thing I do is on stock charts, you can do what's called a candle glance, which is really good. So you can enter up to 10 symbols in here. Again, this is all just free. And then you change this drop box to candle glance, and it'll give you this sort of little snapshot of the charts. You can add indicators and things in here. And they've also got predefined groups. So this is just the Dow stocks. So this is one that I really like to look at pretty regularly. I like to look at which, Dow stocks have been beaten down a little bit, that might be due for a bit of a recovery. You can see Intel has had a really bad run through from April through to the end of May, down about 27%. A lot of issues there with the trade war, things like that. Now sort of starting to recover. It's back above the 20-day moving average. It's had a little pullback and a successful retest of the 20-day moving average. That 20-day moving average is starting to turn upwards. So, I'd probably be cautiously bullish there. And, you can always keep a little stop loss if it breaks below the $20-day moving average again. 3M, pretty similar, really bad downtrend. Also, it was down about 27%. It gets back above the 20-day moving average, pull back to retest, and then rallies again. So that was a really nice one. And then you can scroll down to the bottom and you'll see some of the more stronger stocks in the Dow. I guess we go right to the bottom. Obviously Microsoft has been very, very strong. Walmart's been really good. So, you can find some potential trade ideas here. You can look at Pfizer. That's just been riding that 20-day moving average up really nicely. So, if you can get in early enough on some of these ones and just sell put spreads below and you just ride the market up. So another one that I like the look of was UNH. Had another stock that had a pretty bad downtrend earlier in the year. Got back above the 20-day moving average. That 20-day is starting to rise now. So looking a little bit more bullish. Also back above the 50. The 50 starting to turn upwards. So I don't mind this one over the next couple of weeks. All right, so that's that. That's always a good thing to check. Here's another one, just a group of 10 stocks that I had looking at. EWZ was another one. riding the 20-day moving average on the downtrend, then gets above, and now is into really nice bullish mode. Bots is another one I like. I like this from a fundamental perspective. There's a lot of the way the world's going. It's all about robotic process automation and artificial intelligence. So, I think from a fundamental perspective, this ETF is going to be quite good. And technically, this is just a beautiful, downtrend here. Breaks below the 20, has a really big down move, gets back above the 20, pulls back for a successful retest, and then another rally. So, seen that pattern happen just again and again. You can see the same thing here with EEM. Bud was another one that did that. XOM, let's go back to the Dow. XOM did it as well, broke above the 20, pull back to retest, and then into rally mode. So we've seen that a lot, and I think we'll continue to see that pattern. OIH is another one that's potentially early on in that pattern. Really bad, nasty downtrend, breaks back above the 20. So what we might want to see here over the next couple of weeks is a little pullback to test that 20-day moving average. If it comes back and gets near that 20, that can be a nice time to get long, and it's really easy to set a stop loss there. If it breaks back below the 20, you close the trade, you get out. So that's a potential one to keep an eye on. We can take a look at that. The other one, you can do the same on the bearish side as well, is looking for stocks that have been in an uptrend and then have broken below the 20-day moving average. So UTX was a good one. That 20-day moving average was sloping upwards, breaks below, and then on any subsequent rally, that 20-day moving average becomes resistance. We had a little bit of noise here with the buyout news, the merger. Okay, so that's another one that maybe I'm watching. It's in a pretty clear downtrend here. If this becomes a false break above the 20-day moving average, I could look at potentially getting short here if it breaks back below the 20, because that 20 days declining. It's maybe just a little bit early for this stock, and maybe it's going to have just one more leg down before it can start to find a base. Okay, let's see what else we got here. So we looked at that one. As I said here, you can just enter in your stocks. Here's a couple of really strong group of stocks. And then you go to Candle Glance. And then that'll give you your view. So you can set up a couple of tabs with different watch lists, 10 stocks at a time. That's something that's really handy. Just rather than clicking through and having a single look at each chart, you can just have, I guess, as they say, a glance at each one, and then you can drill down. I think if you just click on here, it'll open up the full chart if you want to have a more detailed look. And just look at that, a beautiful, beautiful chart. Gets above the 20, sort of pulling back, retesting that 20, and then it's just off to the races from there. Little pullback here, find support right at the 20, little break below, but just a beautiful chart. Probably a little bit late now on Visa. Probably needs to consolidate a little bit here. It's a long way above its 200-day moving average. But that's been a really, really strong stock over the past couple of months. All right, any questions, guys, or any other charts you guys want to look at? Send them through. All right, just lost my chat window there. So send them through in the chat. We'll get to those. If there's any that you want me to look at and give my opinion on. All right, but let's go and have a look at some trade ideas. Okay, so some of the stocks we mentioned, UNH was a one that looked really good. Microsoft, yeah, we can take a quick look at Microsoft for sure. As I said, very, very strong stock. That's been an absolute winner over the past few years, really. It's you want to be long stocks that are in uptrends, and it's in a really nice uptrend. It's breaking out to new highs, but you'd want to be pretty cautious here because it is pretty extended. It's a long way above that 200-day moving average, as you can see, and there's also a little bit of divergence on the chart. So What that means is we made a high here and we had a high in the indicator RSI. Now we're making a new high, but the high in RSI isn't quite as high. So it just indicates that maybe the strength of the rally isn't quite there. You can see same on MACD, not quite making a new high. So look, it's a very strong stock. It's very, very bullish, but maybe it's getting a little bit too late. Okay, so if you were going to go long, you'd want to have a very, very tight stop loss, I would say. Okay, definitely wouldn't get short stock. One way that I play stocks like this, and we'll take a look actually, is I'll put a butterfly above the market, say at like 140, and I've done this with Microsoft quite a lot over the last few months and even years. And you hope that in the late stage of this rally, you can usually get those butterflies pretty cheaply. The late stage of the rally, maybe it's just going to slowly grind higher up to that 140 level, and as you get towards expiration, you hope that it's sitting right there in the middle of your butterfly. So that's something that works really well on a stock like this. So you're kind of taking a bullish exposure, but it's not actually costing you much. Whereas if you put on a put spread below, you've got a fair bit of exposure there if the market or the stock does reverse. So that's something that I really like. We'll take a look at that. So good call there with Microsoft. Question from Mark. When do you start to think about a turnaround if the 200 has diverged from the 50, and by what percent? I don't have really a fixed percentage, but look, if something got about 20% above the 200, then that's a pretty big divergence. So let's have a look at Microsoft. What's it here? Look, it's about 21% above the 200-day moving average. And I said the same thing about Amazon and another stock, Alibaba. When everyone was bullish Amazon for a long time, let's go 2 years maybe. Yeah, all through here, through this period here from about July, I was saying don't get long Amazon. Don't necessarily get short, but don't get long because it's a long way from its 200-day moving average. And I said eventually it's going to come back and touch its 200-day, and sure enough, it did. Sometimes that can be through a pullback like this, or it could be through some sideways action, and eventually the 200-day moving average catches up. But it's very hard to get long here when it's been in such an extended rally. Eventually every stock will come back and touch its 200-day moving average. I mean, this was a phenomenal rally. This was one of the all-time great rallies, 100% over 12 months. And it was above, it's probably 20% above its 200-day moving average for a long time. So, just because it's a long way above doesn't mean it can't continue, but for sure that it's going to always come back at some point and touch that 200-day moving average. Yes, Terry, sorry, I'm just seeing that question now. The recording will be available. I'll send that out to you guys. Do I look at commodities and currencies as well? Yeah, so a little bit. I don't find commodities that great for trading options, but obviously GLD is one, SLV, the silver ETF is not a bad one as well. And then I do a bit of trading on the FXA, just around the Aussie dollar. Bit of hedging and stuff like that. Rex, was that Amazon or the whole market that did that last year? Amazon was really the strongest. There was probably a few names that were rallying quite strongly like this. So yeah, it was more specific to Amazon. Alibaba was the other one. Might have been a bit further back in time. So you can see here another one just gets just too far extended from the 200-day moving average, and eventually it comes back and touches it. Now this one was more through some sideways action rather than a big correction. But eventually everything comes back and touches the 200-day moving average. And then the same thing on the downside here. This is actually a really good chart to look at. And we might zoom in on this period because it's perfect technically for some of the things that I look for. It's getting a long way below its 200-day moving average now, and sure enough, it rallies. So let's just zoom in on the back half of 2018. Yeah, that'll probably work. All right, so you can see here, stock makes a low, makes an equal low, but it's not being confirmed by RSI, by the indicator. And then sure enough, it rallies from there. So that's a really good thing to look for, is divergence. If you can spot things like that, that's a great time to get long. And again, you can have a really easy stop loss just a little bit below that recent low. And also if RSI comes down and breaks the kind of, what you do is you kind of draw a little trend line in here on the actual indicator. And then if RSI starts to drop below that trend line, that's when you can get out as well. Use that as a bit of a stop loss. No, I don't really trade futures options, Henrik. What about yourself? Do you trade those? I've kind of looked at it occasionally on crude oil, which can work pretty well. Okay, so let's have a look at a couple of trade ideas. So that Microsoft one, let's do that one first, and see how that might look. So let's say we think that the market's going to grind a little bit higher over the next, what do we got, July's 27 days. So yeah, that's probably about right. So we could do the 140 butterfly. We'll try it $2 wide. So we might come in here, we might buy, let's say 3, we sell 6, we buy 3, and we change our expiry date here so we can see. All right, unfortunately, this is a bit annoying with interactive brokers sometimes. It doesn't look like the prices are coming through properly, but you can see the idea here. Typically with a trade like this, it might cost us a few $100s. Yeah, that's completely off. But you get this profit zone up 2 to 3% higher. You could even go, if you think it's going to drift like 3 to 4% higher, you could put it a little bit higher. But that's something that works really well. Okay, we'll leave that in there, see if the prices come in at some point. UNH was another one that we were looking at. Now for this one, maybe put spreads below, maybe go out to August. Stock's at 247, so you could always sell them at, say, 240, 230. This is going to be really annoying if IB. You know what, let me just pause this for a second, guys. I'll see if I can close and reopen, see if that makes a difference. So we're looking at July and Microsoft. Doesn't look like it. We're out of luck, I think. No, that is a bummer. Sorry, guys. Not sure what's going on there. Let's try United Health. Interesting that we've got pricing on the weekly ones. I mean, we can look at the weekly ones just as an example. I'd tend to go a little bit further out in time. I don't like trading those weekly options, but even some of these don't have pricing. Very strange. Sorry, guys. What I might do is, here we go. We've got some there. So, you could sell a few here. Let's turn that one off. July 12th. I mean, I guess we've got 3 weeks or so for this trade. Yeah, IB isn't, no, here we go. That should be -3, of course. All right, so here you can see, it's a fair bit to risk. The problem with these short-term trades is you can make a high percentage return. You're making like 10% in 3 weeks, but it's a lot to risk, and you've not got a huge margin for error. So, as I said, with a trade like that, you'd want to have a very tight stop loss. So if we go back to United Health, that's the 50 and the 200. Oops. Let's change that to the 20. All right, internet seems to be a little bit slow. Maybe that's the issue. But you can see here, as I said, just riding above that 200, a 20-day moving average nicely. So, you'd set a stop loss at around 244. You can set an alert. If it breaks below 244, you just get out of the trade. Okay. One thing I do a lot these days is I trade a lot longer term. Okay, they just move a lot slower, these trades. You've got a lot more time to react. You've got a lot more margin for error. And if we can hopefully get some pricing in here. So you can see you can even go way further out, give yourself a bit more margin for error. You could do 220, 210. That's a 20 delta. That's not too bad. Even 15 delta would be a good one to short. Sell, we're doing 3. So here you can see we're now making a potential $500 return on 2,500. So that's a 20% return on capital in basically 6 months. Okay, now you wouldn't want to risk your whole account on one trade like this, but if you can have enough little small trades like this, they start to add up and they move pretty slowly. Okay, so what I can try and show you guys is, let's add an interim date here for 1 week's time. All right, so you can see here, if we zoom in, let's say in a week's time, this stock is down 3%. Okay, you can see that here, 3% line here. We go up, this trade would be down about, let's say $120, right? Now, if we compare that to a shorter term trade, if this was down 3%, it would be down 250. Okay, and you can see it starts to drop off even more dramatically. Okay, so let's say it drops 7.5%. We're down about 1,200 on this short-term trade. On the long-term trade, down 7.5, we're only down about 380 or so. Okay, so yes, your profits accrue slower as well. But if something disastrous happens in the stock, you have much less damage on one like this. Another thing you can do, potentially, is you look at your delta on your position. So we talked about, want to talk about hedging and protection today. For example, if earnings is coming up and you want to minimize your delta risk, really, really simple thing you can do. We've got 16 delta here. Provided your broker account allows you to do this, of course. We could sell 16 shares. Now we're perfectly delta neutral. You could just do that for a day or two over earnings if you wanted to, if you didn't want the exposure. You can see we've still got a nice, healthy potential profit graph. You see that interim, that 1 week line is now much, much flatter. We've got much less directional risk. We can withstand, 7% move up and a 7.5% move down before we start to really have any sort of losses at all. So, that's something that I'll do pretty regularly. You don't have to hedge the whole amount either. You might just do, -8 shares. So that's another one. You could potentially even just leave that position as is for the duration. You're still going to make a pretty decent gain if the stock goes up. You're going to make a couple of $100, 10%. And you might even make a little bit more if it goes down. So that's one way you can protect yourself. And also as a overall sort of portfolio, you want to look at your delta exposure. This delta dollars figure is something that I use a lot. I won't go into too much detail today, but that's a really good thing to look at that helps you, just understand what your exposure levels are. You want to have, don't necessarily want to have all positive delta trades. You might want to have a few negative delta trades to help offset. Okay. So like we were looking at UTX earlier, maybe if that breaks below the 20-day moving average, that's one where you want to get short. That helps offset some of your positive delta that you've got elsewhere. And, overall your portfolio might be, more towards the delta neutral. Some people like to stay completely delta neutral at a portfolio level. Others might want to have, as I said, with being my opinion being sort of cautiously bullish right now, maybe I want to have like a 20% or a 30% long delta exposure in my account, right? Tony saying how to get delta dollars in TOS. I'm not 100% sure. They may call it something different, like delta notional or something like that. I can't remember what they call it if they have it, but I think you can get it. Just remind me, send me an email, Tony, and I'll see if I can look into that. But it's actually a really simple calc. You basically just take, we've got 16 delta here. You just take that times the stock price. So 16 times 252 is going to give you $4,000, right? So you could always export to Excel and do the calc yourself really quickly if you had to. But I think Thinkorswim may have it as well. So just send me an email, Tony, and I'll see if I can remember how to do that. Someone's saying please hit Alt and Cont and F to reset option prices. What's CONT? Control. Alt Control F. All right, let's try that. Not nice idea, but not sure that's working. No. It'd be nice if we could get that working. But anyway. All right, so that's a couple of trade ideas. What else could we look at? We talked about, XOM was another one that was exhibiting that pattern that we were looking for. So, this is the world's biggest oil company. It's a Dow stock. I think it's the 13th biggest stock in the market in terms of market capitalization. I'm happy with a stock like that to take some long-term exposure. I could go out to November or January even. January is pretty long-term, but you can see when you go long-term, you can get really far away. We're trading at 76. The 20 deltas are down at 67.5. So we could, let's just stick with 3 contracts again. Okay, so there you can see, really long-term trade. It's going to move very, very slowly. But we've got $200 potential gain on 1,300 at risk. So what's that? I'm going to have to calculate that. 15%. There you go. That was actually pretty easy, wasn't it? So that's a 15% return in 7 months. Okay. So you do a couple of those. You do that through to January, then you do another 5-month one. You're looking at a 30% return almost for a year, and you've got a 13% margin for error as long as the stock doesn't drop 13%. So that's the sort of thing I'm looking at these days. And then what you can do, if the stock does rally up, let's say it goes up 4 or 5%, you're sitting on some small gains, you can actually end up turning it into a condor. You can then, when it gets really, really overbought, you can do the same on the upside. You can sell the call spreads again about 12 15% away and turn it into a condor. That's something that works really well. So again, XOM, don't mind a trade like that. Let's just go back and look at the chart of that one. Yeah, that's a really nice looking chart. You know, the stop loss, you could set it if it breaks 74. All right, you can just set an alert. If it breaks 74, maybe once a week you update your alert depending on where the moving average has gone to. You know, with some brokers, you know, you might even get, you might even be able to set an alert if it breaks the moving average, right? All right, question from earlier in terms of taking profits. Look, with a trade like this, again, it really depends on what trade you're doing. But with a trade like this, I'd want to be trying to hold to expiry, or very close to. But if you took, you know, that's a pretty small exposure. If you had a bigger position, you know, another thing you could do is set like a 20% stop loss, 20% profit target. Okay, so here you're risking, say, 4,300. So you could set like $100 profit target, $100 stop loss. You know, maybe if you can get out with $100 within a few weeks. You know, the other thing you want to look at is how much time has expired. You know, how much time has passed. If you know, XOM shoots up, you know, 5% in a week, you know, you're sitting on a pretty nice gain. You might want to close it out there because there's no point waiting another 6.5 months to get that remaining 500, right? So it does depend on the strategy. It depends on what the underlying does. But look, with any sort of option trade, a 20% stop loss is good, and even 20 or 30% profit target. Yeah, exactly. Tony's sort of saying the same thing. If you get a 50% credit in 1 month, do you roll? Yeah, exactly. You could do that. You could roll it up if you're still bullish. Yeah, so definitely if you're getting to that 50% credit of the credit, what are we at, about $700? If you're up sort of 350 pretty early on in the trade, you could close it out, or maybe you condorize it at that point. Yeah, things like that. Okay, so another one for some of those stocks that are drifting higher. This is another thing I've done on Visa that works pretty well. Is a diagonal spread. So this one I'm prepared to go usually a little bit more shorter term. Again, we think that maybe the stock's going to just sort of drift higher over the next couple of weeks, trading at 173. We might come in here and sell the 177.5. So we're selling that for about $1. Then I want to go out a few weeks later, maybe August 2nd, and we want to buy an option for around $1. This one's a little bit more expensive, or we go a bit further out. Let's try that one. So let's say we sell that one, we buy that one, and we'll change our expiry here to July 12th. So here we've got a trade where we've got very little risk on the downside if it does drop, okay? But we've got a nice little profit zone just slightly above if it gets up into this area. This is a little tight, only 2 to 3%. You know, I'd probably prefer to be a little bit further away, actually. That 26 delta is maybe a little bit aggressive. But it's kind of similar to that butterfly. Maybe even a butterfly would be better in this situation. Let me see if I can show you what I was trying to show you with Microsoft. July 12th. So let's say we think it's going to go up to about 177.5, maybe even 180. Let's just have a look, see if we can get this working. Let's see if Microsoft prices, no, it's still not there. All right, so 3 minus 6 and 3. Okay, so here we go, this looks better. So very little risk what's that, about 90 bucks maybe. And we've got a really nice profit potential if Visa rallies sort of 2.5 to 5%. Okay. Really nice profit zone in here. Now this can work really, really well. This is a nice trade that doesn't cost us much. We've got very low risk and we've got a really nice profit potential. If we change, so that shows us in percentage, we can also look at that in terms of the stock price. So let's just zoom right in here. So anything between sort of 178 and 182. Okay, so look at this chart. What do you think the chances of this over the next 3 weeks just kind of drifting higher and ending up at around 178 or 180? Not bad. Maybe you'd want to come a little bit closer. Maybe it's sort of 178. But that's a really nice low risk, high reward trade that you can do. If we do it at 178 or 177.5, it's going to cost us a little bit more, but maybe it's a little bit more likely to, get up into that zone. So let's just take a quick look at that. This is going to be a little more expensive, I think. Okay, it's not too bad actually. It's only costing us, only about 120. So that's not too bad. Only an extra 20 bucks to risk, but we've brought our profit zone a little bit closer in. So probably prefer that one actually, because I think the likelihood of it ending at around 177.5 in 3 weeks' time is probably a bit higher than it getting all the way up to 180. You never know. It depends how bullish you are. If you're really, really bullish on it, you'd go the 180. But the sake of only costing us an extra 20 or 30 bucks, maybe that's going to end up here. I wonder what it would look like actually if you did a combination of the two. So we'd end up going, we'd do that, then we'd add in another, so that would go to, we'd buy 3 of those, we'd sell 6 of those, which would get us to -3. So it's like a combination of the two. You put the two together. Almost looks a bit more like a condor sort of shape, but we're putting it up above the market, gives us a bigger zone, costs us a bit more. So not sure about that. I think I probably prefer just the single butterfly, but that's something that works quite well on those stocks that just continue to grind higher. When do I enter these long-term trades? Only in high vol times. Yeah, that's an awesome time to do it. You're getting, remember with that futures curve though, a lot of times when you get these volatility spike, it doesn't impact the back end of the curve as much. Kind of an advanced topic, but we can cover that in more detail another time. But yeah, when volatility is high, as I said, when it looks like the trend is changing and you can kind of just ride that trend higher. And then as Tony said earlier, you get your profit target, then you kind of just continue to roll them up and just ride the market higher. Erky is saying, do I use Interactive Brokers alerts or some other system? So yeah, I've got 2 things I use. Interactive Brokers is one, and then there's another app called Stocks Tracker, which is I think it's 20 bucks maybe, but you can set alerts in that one as well on your phone, and that's a good one for me. With being in Australia, the markets are, most of the time they're closed while I'm open while I'm asleep. So I'll set alerts in that, and then that'll sort of buzz in the night if certain levels get hit, and then I can get up and do what I need to do. So that's another one to look at. As I said, that's about 20 bucks, but there may be some other apps out there these days as well. But that's just one that I've been using. And I think there is a way to alert on the spread price, but I'll have to look into that and get back to you. All right. So one other quick thing that I'll show you guys that I look for is stocks that have been consolidating. Sometimes you can see that based on, your candle glance that you're looking at. Let's see if we can maybe find an example. Not really seeing a lot of stocks are just sort of trending up at the moment. But you'll have your watch list that you go through. Maybe JP Morgan could be one. Been going sideways for a bit now. So that could be a good candidate. And then what I'll do is I'll add in Bollinger Bands. Might even just turn the moving averages off so that we can just focus on that. And we'll change that to Bollinger Band width and update our chart. Okay, so what I like to do is look for stocks where the Bollinger Bands have been quite tight for a while. So you can see here was a pretty good period. We had 4 to 6 weeks where the bands were quite tight, and then we start to get some breakouts. So that's a good time to go into trades like a long straddle or a long strangle. So potentially here as well, we've got RSI just bouncing around that 50 level. The Bollinger Bands are quite tight. They haven't been tight for that long. But you can see here Bollinger Band width is about as tight as they ever get. So maybe at some point shortly, we're going to get a breakout either way. So that's one to watch. Maybe look at that over the next 3 or 4 weeks. If that stays relatively tight in that sort of 106 to 111 range, that could be a good candidate for a breakout trade. And having those long vol trades can be a good sort of offset to some of your regular trades that your condors and things like that are going to be short volatility. So it's always nice to have a few of those ones like that in your portfolio, just in case the market does tank or something like that. You'll get a little bit of a boost from these breakout trades. All right, guys. So we'll leave it there. I hope you guys enjoyed today's session. If you want to get in touch, happy to get on the phone with you guys. You can add me on WhatsApp is a good way to contact me. So there's my number there. You can also add me on Skype. If you want, just shoot me a message. Let me know when you're up for a chat. I can give you a call. These webinars are great and you guys can ask questions and things like that, but sometimes it's better to just have a quick one-on-one chat as well. So happy to do that for any of you guys if you want to. So I'll leave that up there for a minute while you grab that, write that down, and then just give me a buzz. I've got pretty free day today. If anyone wants to have a chat later, that's great. I know some of you put your phone numbers in already when you registered for the webinar, so I'll definitely give a few of you a call today and just have a little chat and see how else I can help you. Thanks, guys. Appreciate that. Very good. I'll try and do a few more of these webinars going forward as well. Any questions, anytime, just shoot me an email, info@optionstradingiq. If you don't want to give me a call, that's fine. Cool. Thanks, Mark. Thanks, Terry. Great questions today, guys. Great attendance as well. And I think that's it, guys. Really enjoyed it, and I hope you guys did too. Thanks, Steve, and look forward to chatting to you guys soon. Thanks, Chris. Cool. All right, take care, guys. I'll talk to you soon.